the table set for tomorrow's Fed meeting is such that there's not really a big gap between the market's expectation and what the Federal Reserve said last time. In their last forecast, they told us that GDP would be right around 2 to 2.4%. They said the unemployment rate would be 3.9 to 4.1. Inflation, 2.3 to 2.7. And when you look at where the numbers have fallen, we're basically in the midpoint of many of those ranges. The market's pricing in one rate cut for this year, and the Fed is probably going to bring us down from 3 to 2 or 3 to 1. So how much of a surprise could tomorrow be? I know that we have an inflation report in the morning. Anton, you and I were talking about this, and I'm going to use the reverse Uno card here. I want you to explain to everyone else why there isn't more volatility priced into this market for a Wednesday when you have two discrete events that usually would bring about a good deal of price action on their own.
Tomorrow's event. So right now, and we were talking about this yesterday in futures power hour, so it is kind of interesting. We're looking at the S&P 500. Tomorrow's expected move right now for tomorrow's close, so the June 12th options being priced at 55 points. That's the IDX number for tomorrow's expiration. So usually when we have a singular event, right, we'll have, and especially in the last few months, we've had an expected move of about 50 or 40 points for one of those events. Now we have two of those events, and right now the expected point move is only like 55 points. So a lot of people are saying, well, it seems so low. Why isn't it like 80 points, right? Because you have usually one that's 40 points, another one that's 40 points usually. Why is it only 55 points? And this is kind of like, ironically, diversification of events. You have one. If you have two individual events on a single day, the total risk from them is less than if it were two individual events on two separate days, which is why we get a lower expected move. Now, I think personally, now the question is like, will both of these moves actually amplify whatever happens tomorrow? Like, will it be a double whammy effect where you have the Fed moves the market higher, that's already amplified by an inflation number that moves the market even higher, or will it be a completely non-event day, right? Honestly, I think that you may have one of those two options as opposed to kind of like, like a 50-point day. I think you'll either have like a 0-point day or like a 90-point day. And that's why they expected moves price right there, right in the middle, I think. But yeah.
Well, the SPX.
I don't know why you asked me that.
I'm looking at the SPX. Well, I'm sorry. I'm looking at the VIX one day, and that seems to be creeping up. Volatility /VX seems to be creeping up. The move of 55 versus basically 20 today is almost 2.5 times as great because of this number on Wednesday, right? You're looking at 0-day options today. Earlier they were 17. I think they're 18 now and change. Volatility is upticking a little bit because the market's going a little bit lower. With 1 day to go, you got 55 expected move, and with 2 days, you got almost 65. So only 10 points between the two. So this really does look like a binary event to me that the market's pricing in, I think, fairly aggressively. Is that the point you were trying to make, Anton?
Well, I mean, yeah, there are two binary events tomorrow. There's the inflation number and the Fed
minutes, yeah.
And yesterday, Chris. So we got a little bit of a I don't want to say a squabble, but a kind of a misunderstanding because I only thought there was one event. Because I was on vacation last week, so I didn't do the show with Chris last week. So Chris informed me very graciously, like, no, Anton, there are actually two events. I was saying before I knew that 55-point expected move looked actually pretty high.
Right.
Chris said it was actually pretty low. And I was like, well, what do you mean it's pretty low? I mean, we've had expected move. I'm sorry, why do you mean it's pretty high? We've had expected moves like 40 points. It's not like that low. Sure. And then he said, no, Anton, you dummy, there are two events tomorrow.
Right.
That's why it's so low. And I'm like, oh, that makes sense. So then we started talking about why the expected move isn't higher theoretically if compared to you have like two individual events, right? If you have an individual event that's 40 points, then two should be theoretically 80 points, but it's only 50 points, right? So why is it lower? And the answer for that, again, it's when you have two independent events on one day, you actually get a lower expected move than if you were to sum two individual ones together. Kind of like when you have two individual stocks in your portfolio that have earnings, you put both of them in your same portfolio on the same day. The risk on your portfolio that day on average will be less than if you had those earnings on two separate days. It's the same concept of diversification, just applied to options.
That was a great analogy, Anton.
And I think that's an important thing for people to understand, because if you think that vol is understating the macro risk for tomorrow, you may do something like buying an at the money strangle or a reverse iron fly, something that tells you that the market's not going to stay here and get unpinned. But reality is, as Anton explained, well, these two events, they don't just add them together. There's a bit of a diversification perspective here. And quite frankly, forget the mechanics. Why on earth would we react to an inflation report when the Federal Reserve is going to tell us what to think and what to feel about it later that afternoon? The world the Fed's put us in right now is one of data dependence. There's really a continuum here. There's forward guidance and there's data dependence. And forward guidance means the Fed tells us this is what they're going to do for an extended period of time, and nothing can stop them from doing that. So a PPI report, a CPI report, these things really don't move the needle. And that was the case in the 2010s. Lots of forward guidance. These days, being data dependent, we overreact to everything because we want to see or feel what the Fed may think or see or feel and try to skate to where that puck's going to be. There's really no gap tomorrow. The second the inflation data comes out, the market's attention goes right to that 2 p.m. FOMC rate decision, the 2:30 p.m. Eastern press conference with Jerome Powell, and he's going to tell us everything we need to know about inflation if the Fed thinks it's a bad report or a good report. And so I think just for tomorrow's setup, this inflation report is probably reduced in terms of market impact. If it was coming out today, different story. We have time to speculate. But tomorrow, inflation actually could be a non-event in the grand scheme of things, because the Fed is going to tell us whether or not we should care about it a few hours later. That said, go ahead.
No, I was going to say, I think the market's telling you already that with bonds at 117.04, and they already tested the downside, the market really didn't react to it. Actually, it's having a little bit more reaction to the bond move yesterday, today, more than anything. That, I don't know, I think it's going to be a big nothing burger. I think it's going to be a big non-event. We'll see.
I'm with you.
Mm-hmm.
Yeah, I mean, here's the thing that I've noticed about Fed announcement days to begin with, and I've traded a lot of them. And again, I like to do some of those zero-day options, as you all know. But on the Fed days, I think have been consistently my most successful days, trading them from a neutral perspective, right? You kind of sell the iron fly or buy the butterfly, whatever you want to call it, right? And the reason is because you've had so many days where you have that initial move. And Tony, you said earlier today that you like to fade that initial move. So you put basically you had that initial move after half hour. So the initial move reverses lower than where it initially started. And then it reverses back onto the close. So it's almost like this. And I say that so specifically because we've had so many days where that's exactly how it's happened. So again, if you're adding kind of everything that Chris just said, I think it could be a day like that, but just a lot more volatility, but still end up almost exactly where we started. Just like you said, a big nothing burger, right? Mm-hmm. With a lot more intraday volatility, which is why I think that expected move is just a little bit higher than a typical standalone Fed FOMC day without the inflation report. So kind of like what we had 6 weeks ago. It was about 45 points or something like that. It's a little bit higher than that, right? Because you have essentially that extra risk priced in, but will it actually make a difference by the end of the day? I don't know. I'm going to say probably not.
Once we get through tomorrow, that's really it for macro risk this week. There is an important 10-year note auction today. So people that are trading bonds, I know that we had a really big sell-off on Friday, but yesterday's 3-year note auction was not good. It tailed through, lower bid to cover ratio. If you want to know what those terms mean, go over to tastylive.com, news and insights tab. There's how to read a bond auction article up there. But the point is that there's not a lot of demand for U.S. debt right now. And with the 10 years today, it could set the table for a softer Wednesday morning. And we can't ignore the overnight event risk. Tony, it's another one of these days where the market's a little softer going into the U.S. trading session. Like we saw at the start of this week, there's some problems going on in Asia and Europe right now that are making investors a little squeamish, as it were. And so we'll see if today becomes another one of those, once European markets close, can U.S. markets rally back? They have a window until 1 p.m. Eastern. Then you get your auction, the 10 years, and then the rest of the day, c'est la vie. But this is a really odd week because once we get through Wednesday, the macro calendar for the rest of the month is effectively clear. There's nothing that you really care about. And the earnings calendar gets really dry really quickly. We can go into a prototypical low vol summer melt up type of scenario if the Fed doesn't rock the boat too hard tomorrow. And I feel like that would be the most painful trade for most people out there because no one likes this rally right now. Everyone says it's overvalued, overextended. So what a way to stick it to those people by tacking on another 100 points to ES here.